They told you silver was expensive. They didn't tell you it was unavailable. This week, something far more dangerous than a price spike happened. The market crossed an invisible line, the point where money no longer guarantees delivery. On paper, silver trades freely. In reality, buyers are being turned away, premiums are exploding, and shipments are being delayed without explanation. So ask yourself this: when a market still trades, but the product disappears, is that a rally or a failure? Pause for a moment. Don't look at the chart, because the real signal isn't the price, it's the absence. And to understand how we reach this point, we have to dissect the system from the inside out. To understand why silver can trade at 74.5 and still be impossible to buy, we first need to separate two markets that look identical on the surface, but behave very differently underneath. There is paper silver, traded through futures contracts, ETFs, and derivatives. This is the silver you see quoted on screens, cleared through exchanges like COMEX. And then there is physical silver, the metal mined from the ground, refined, cast into bars or coins, and delivered to manufacturers, governments, and investors. For decades, these two markets moved together, but over the last 5 years, a structural imbalance has been building. Since 2021, the global silver market has run persistent physical deficits, with annual shortfalls estimated in the range of 200 to 250 million ounces per year. Unlike gold, silver is consumed. It disappears into solar panels, electronics, medical equipment, and defense systems. Recycling has not kept pace. New mines take 10 to 15 years to bring online. At the same time, demand quietly shifted. What was once primarily an investment metal became a strategic industrial input. Every electric vehicle, every solar installation, every advanced weapon system now requires silver, often in quantities that cannot be substituted. This is where the system becomes fragile. Refiners and manufacturers still rely on futures markets to hedge their costs. But when prices rise too fast, those hedges trigger margin calls, massive cash demands that arrive overnight. Suddenly, producing silver becomes less about mining capacity and more about liquidity survival. For the average person, this matters more than it sounds. Silver shortages don't just affect investors, they ripple into energy prices, technology costs, and ultimately the cost of living. So the real question isn't whether silver is overpriced, it's whether the system that delivers it can still function. And that brings us to the mechanisms now pushing the supply chain toward its breaking point. What ultimately snapped the silver supply chain wasn't a single event, but a collision of mechanisms that were never designed to operate under stress. At the center of the system sits the refiner, the quiet middleman between mines and end users. Refiners buy raw silver feedstock and hedge their exposure by selling futures contracts. In theory, this protects them from price swings. In reality, it creates a trap. When silver prices rise rapidly, futures positions move against refiners. Margin calls arrive not gradually, but overnight. A $2 move can demand tens of millions of dollars in additional collateral before the next trading session opens. For some refiners, meeting those calls means diverting cash away from operations. For others, it means reducing output or halting shipments entirely. The metal exists, but it stops moving. At the same time, demand is no longer flexible. Electric vehicles, solar panels, data centers, and military systems all require silver in precise quantities. A modern EV can contain up to 100 grams of silver, while solar installations consume silver in volumes that compound with every gigawatt added. These buyers don't care about spot prices. They care about supply certainty. When availability becomes questionable, they pre-buy, lock in contracts, and remove metal from the open market, accelerating shortages for everyone else. On exchanges, silver appears liquid. Contracts trade. Prices update by the second. But the vast majority of these contracts are never settled with physical delivery. This works until participants start demanding the metal. As inventories decline and delivery requests rise, the system relies on cash settlement and rollover incentives. The price remains orderly, but trust quietly erodes. The moment buyers realize price no longer guarantees access, the futures market loses its signaling power. Normally, higher prices attract new supply, but silver's supply chain doesn't respond quickly. Mines can't ramp overnight. Refiners face regulatory and energy constraints, mints hit capacity limits. Price can rise, but metal still won't arrive on time. And when price fails to resolve scarcity, markets don't adjust smoothly. They fracture. This is why 74.5 isn't a ceiling. It's a warning that the system designed to balance silver supply and demand is no longer doing its job. To grasp the scale of what's unfolding, silver must be viewed through a global lens, because this is not a localized shortage. It is a systemic imbalance spreading across regions. China sits at the center of the industrial silver world. While it does not control the majority of global mining output, it dominates refining and downstream manufacturing. Solar panels, electronics, and strategic components flow through Chinese supply chains. When Chinese firms sense instability, they don't wait for price signals. They secure long-term contracts and stockpile material, quietly removing silver from global circulation. The United States, by contrast, is structurally vulnerable. It imports roughly 75% of the silver it consumes. Domestic production is limited, refining capacity is constrained, and industrial demand continues to rise. When physical supply tightens, the U.S. has fewer buffers. Delays translate quickly into higher costs, canceled orders, and missed production targets. Europe faces a different pressure point. Its aggressive energy transition depends heavily on solar infrastructure, one of the most silver-intensive technologies in the modern economy. As prices rise and deliveries stretch, projects slow, budgets break, subsidies come under strain. The consequences cascade. Directly, manufacturers face higher input costs and unpredictable delivery schedules. Dealers ration inventory or suspend sales. Premiums detach from spot prices. Indirectly, the effects widen. Clean energy targets slip. Consumer prices edge higher. Supply insecurity feeds political tension as governments scramble to protect strategic industries. This is how commodity stress migrates from warehouses into boardrooms and eventually into everyday life. When silver becomes scarce, it doesn't just disrupt markets, it destabilizes plans. When a supply chain fractures, there are no easy fixes, only trade-offs. For investors, the first adjustment is psychological. In a market where access matters more than price, physical silver behaves differently from financial exposure. Paper instruments may track charts, but they do not guarantee delivery. Those seeking protection prioritize liquidity of possession over liquidity of contracts. For industry, the response is already underway. Manufacturers are extending procurement horizons, locking in multi-year supply agreements, and investing in material efficiency and recycling. Yet these measures offer mitigation, not resolution. Recycling can supplement supply, but it cannot offset years of structural deficit. Governments face even tighter constraints. Opening new mines takes a decade or more. Environmental approvals, capital requirements, and geopolitical risk slow every step. Strategic stockpiles can buffer shocks, but only temporarily. Looking ahead, two scenarios emerge. In the short term, price volatility increases. Premiums remain elevated. Spot prices lose their role as a reliable indicator of availability. Supply disruptions become episodic but persistent. In the long term, the market must rebalance, either through significantly higher prices that ration demand, or through technological substitution that reduces silver intensity. Neither outcome is painless. What could reverse the trend? A global slowdown that destroys industrial demand, a breakthrough in alternative materials, or decisive policy intervention that reshapes supply chains. Absent those shifts, the direction is clear. Silver is transitioning from a traded commodity into a strategic resource, and markets are only beginning to reflect that reality. Silver did not fail because demand exploded overnight. It failed because a system built on leverage, timing, and trust finally met physical limits. A market can trade without metal, but it cannot deliver without consequences. At 74.5, the question is no longer whether silver is expensive, it's whether it's available at all. History shows that when access disappears, prices follow, violently and without warning. Those who wait for confirmation usually receive it too late. This is not a prediction, it's a pattern. Don't outsource your understanding, don't rely on headlines. Study the mechanisms, watch the supply chain, not the chart. Because when the system snaps, the price you see is never the price you pay.